Welcome everyone to our program today. We are going to talk about best practices for running a family foundation. I'm Michele McKinnon, and I'm with my partner Brad Ridlehoover. We're going to try to give an overview of some of the rules that are important to know if you have any involvement with the private foundation. Several years ago, probably actually over a decade ago, the IRS did an audit on smaller private foundations, assuming that they were going to find all kinds of errors and mistakes and tax violations. And the reality was most of these foundations were being run properly. And the key to that is making sure that everybody understands the rules. And they don't have to know every nuance of the rules, but to have a basic understanding of where the traps are and when you need to be worried about a particular transaction involving the foundation. And so that's what our goal today is to give you a good overview of what the rules are and what you should know if you're working with a private foundation to make sure you don't get into trouble, because the tax rules are not forgiving if you violate them. So we're going to start today with an overview on just what is a private foundation, the general requirements that have to be met for all 501c3 charitable organizations. We're going to talk a little bit about public disclosure, and then we're going to really spend most of the time on the special tax rules that apply to private foundations, with an emphasis on the self-dealing and taxable expenditure rules primarily, but also briefly address the required minimum distribution rules, the excess business holdings rules, and the jeopardizing investment rules. So at this, I'm going to turn it over to Brad and get us started on just an overview of private foundations and what they are.
Great. So when we're thinking about a private foundation, we have to remember the starting point is a private foundation is also, or must be, a 501c3 organization. So it must meet the general requirements, which are organized and operated for a purpose that's permitted under 501c3. That could be charitable, scientific, religious, literary, or educational purposes. The difference between a public charity and a private foundation, however, is that generally a private foundation, especially non-operating or family foundations, are going to have a single major source of funding, the family. That doesn't mean they couldn't take in money from outside sources, but majority of the clients running family foundations, they're primarily taking money from the family that's the funding source and the part of the governing body. Now, their primary activity of the foundations we're going to talk about today are usually grant making. There are other types of foundations out there, operating foundations that engage in direct charitable activities. Today we're going to focus more on those that are out there just operating to give grants to other charitable organizations. But we will say that, there are different types that still fall within the private foundation world. Also, there's ongoing funding usually thought through with investment returns. So you have a family foundation that's created with an initial contribution that could be supplemented in later years, but they're going to be invested, and that money that's invested will help generate additional funds available for use in grant-making purposes.
And Brad, I think one thing that's important to point out, with private foundations, one of the primary advantages or attractions for many clients is the fact that the family, or if it's a company foundation, they can control it completely. You don't have to bring in outside people.
Right, and that's the difference between a public charity where you're going to see like your United Ways or your Goodwill, where you're going to see a more diverse group of people on the governing body. Following along with the 501c3 rules that are subject, that private foundations along with public charities are subject to, you can't have private annulment, you can't have private benefit, only an insubstantial amounts permitted, very limited amount of lobbying. But for private foundations, we always note that there is an excise tax on any lobbying that's activity that's engaged in, and that generally results in it just being prohibitive, so that private foundations don't do any lobbying from our experience. And then all charities are prohibited from participating or intervening in political campaigns, which is different than lobbying. One of the things we're going to talk about today is that, obviously they make distributions throughout their existence to charities, but there must be information in their governing documents that describe what's going to happen if they are to dissolve. So if the foundation is to go away or terminates and dissolves under state law, there must be provisions about what happens to the assets upon that dissolution. Just like public charities, private foundations have to file annual tax returns. It's a different form, Form 990-PF, to do the 15th day in the 5th month at the end of the tax year, similar to public charities. But the form has different questions and different responsibilities to disclose information. what we're going to do today, is think about why there's these special rules that are applicable only to private foundations and don't apply to public charities. A lot of times, private foundations, because of this tight control with a family or a company that's founding it, there are some special rules that overlay the general rules that we just talked about to ensure that we're still benefiting the public. And these rules really focus on making sure that the operational side of the foundations meet some certain special rules. Now, there is a tax. We say that private foundations are tax exempt, public charities are tax exempt. There's an exception. Private foundations do pay a small tax, a 1.39% tax on the net investment income. And then there are a list of other things that we're going to go in more detail about today, including what is self-dealing, minimum distributions. You may think of, that foundations that are non-operating have to distribute 5%. We're going to talk about that today and what that means and what are the common issues there. Excess business holdings, a lot of times that comes up when there's a transfer of a closely held business. We're going to talk about the traps for the wary there. Jeopardy investments, just thinking about where you're investing your money and being prudent to generate returns for the foundation. And then taxable expenditures, we're going to go over in more detail about what are things to look out for and where you want to be careful that we're not violating any of these rules. A lot of times when we're doing this, we're going to kind of go, we don't have a lot of time today, so we're going to go quickly over a few things and focus more on the common issues, spend a little more time giving you examples. But as I mentioned, there's a 1.39% tax on the net investment income. This is the sum of the gross investment less and net capital gains reduced by investment expenses. This is not the money that is related to actually operating your charitable activities. This is the investment side. And if you have investment income, you're going to have to make quarterly payments of estimated tax if the tax is greater than $500. Those are all done electronically these days.
And there is one issue that typically I've seen it arise. If a private foundation is working with an investment manager and they decide to change managers, I have seen the new manager go in because they want to invest it the way they want to invest, and they sell everything. And they don't realize that it's a private foundation that pays the tax. So you should always be careful. I mean, it can be a significant tax if there's significant capital gains in those as a result of that sale. So always be cautious if you're changing managers or doing significant changes to the investments, that you're at least aware that you might be incurring tax that you wouldn't otherwise.
All right, so moving on, Michele, to the more challenging issues that private foundations face, let's focus now on self-dealing. And what does self-dealing mean?
Yeah, and self-dealing is this is probably the area when in our practice that we deal with the most when we're advising private foundations. It's the easiest place, I think, for organizations to get into trouble. And what self-dealing in the context of private foundations is a concept that basically imposes an excise tax on certain transactions between the private foundation and persons who are disqualified persons with respect to that private foundation. And we'll talk about that. The one key thing to note is it doesn't matter if this is a transaction that is highly beneficial to the foundation. If it is one of the designated acts and there's no exception available, it results in an excise tax. And the tax is not paid by the private foundation, it's paid by the disqualified person who engaged in the transaction. And then in some cases, if they're involved in the decision to do this, the directors or trustees or the officers can also have liability for tax. The tax on the disqualified person is 10% of the amount involved. And then if a director or trustee or officer has liability, it's 5% of the amount involved, but it is joint and several liability and capped in the aggregate at $20,000 per act of self-dealing. Because these are punitive taxes, if you have to go and fix whatever you did. So if you engaged in an act of self-dealing, you've got to undo the transaction and make the foundation whole again. If you don't do that, there is an additional, over and above the original tax, additional tax of 200% imposed on the disqualified person and 50% on the directors, trustees, or officers, capped again at $20,000 with joint and several liability. These are punitive taxes. They are designed to prevent these things from happening. It's not to say that it doesn't occasionally happen and we have to deal with it. And it's not the end of the world to have to report an act of self-dealing. The key is finding it early, fixing it, and then reporting and paying the tax. as needed.
And the cap is on the officers and director side, not necessarily on the disqualified
No
person.
tax on, no cap on the disqualified person, and also no reasonable cause exception for the disqualified person who engages in an act of self-dealing.
So in these scenarios, it's important to, if you identify them, to correct them before you get and make these tax filings and payments. Mm-hmm. But we do see it come up when the IRS audits private foundations. So there can be times if you don't identify them, and in those scenarios, you can be facing additional penalties and other things.
Yes, generally all of these potential tax liabilities are self-reported on the 990 PF. And it's, again, not the end of the world if you have to report one, as long as we fix it. So the key to understanding an act of self-dealing is to figure out who is a disqualified person, because those are the only people who could engage in an act of self-dealing. So generally, disqualified persons are substantial contributors. Those are generally anyone giving more than $5,000. And it's usually in the case of a family or a corporation, it's easy to identify the substantial contributors. Foundation managers are also disqualified persons, and that includes directors, trustees, or officers, or people who have similar roles to those and authority. And while normally you think in a family foundation, it's the family members, if they bring an outside person on, all of a sudden you have another line of disqualified persons involved. Any owner of 20% or more of a business that is a substantial contributor is also a disqualified person. And then family members of all of the people above there, the substantial contributors, foundation managers, they're also disqualified persons. And that for purposes of the private foundation rules goes up and down. It's ancestors and descendants and spouses of all of those people, including the substantial contributor. But collateral relatives do not get picked up, and that is different from some of the rules that apply on the public charity side. Any corporation, partnership, trust, or estate in which persons, in which disqualified persons described above have an ownership or own more than 35%, that corporation, partnership, trust, or estate will also be a disqualified person. So sometimes you have to do a lot of working through who owns what when you're trying to figure out whether or not you have a disqualified person. Any government official is also a disqualified person. That's a rule that rarely comes up, occasionally, but there are special rules about transactions with government officials. So now we know who could engage in an act of self-dealing with the foundation. Now, what are acts of self-dealing? And these rules pick up not only direct acts of self-dealing, but also indirect acts of self-dealing. And indirect acts of self-dealing are not clearly defined in the regulations or in the code, but it is deliberately very broad, and that's the way the IRS wants it, and that's the way it is. And so those indirect rules can also make it difficult sometimes to analyze whether you have an act of self-dealing. But in general, acts of self-dealing would include any sale, lease, or exchange of property between a private foundation and a disqualified person. Now we're going to talk about a number of exceptions, and there is one for leasing. There are no exceptions for sales and exchanges of property. So if the sale is a great deal, let's say somebody sells a piece of property, a disqualified person sells a piece of property for 10% of its fair market value. That's a good thing for the private foundation, you would think. That is an act of self-dealing. You cannot sell anything to a private foundation, and vice versa. So I always tell clients to remember, if you put something in your private foundation, you are not going to be able to get it out and buy it, but even if you buy it back. Any lending of money or other extension of credit between a private foundation and a disqualified person, and this can trip you up sometimes because of just how you're accounting for things, or particularly in the family office context and other things. So you just have to be careful there. I mean, obviously, a direct loan, you would know that that's going to be a problem. Any furnishings of goods, services, or facilities between the private foundation and a disqualified person. One of the other rules that we deal with regularly is the compensation rule. And the private foundation cannot pay compensation or reimburse the expenses of a disqualified person But as we're going to see, there's a very broad exception to that rule that is unique to private foundations and actually more useful than in the public charity context. And then the big one that a lot of different types of transactions fall into is the transfer to or use by or for the benefit of a disqualified person of the private foundation's income or assets. That is a deliberately broad provision and can pick up all kinds of transactions and financial arrangements. And then any agreement to make a payment to a government official.
And the reason that would come up is if you end up having a government official on your board.
Or I've had a staff member who was a government official, and we realized it and realized we had some issues. There are some rules around it and guidelines, but I've only had that come up once in my practice. But when it comes up, it's got to be dealt with. The key to understanding, in addition to knowing what are acts of self-dealing, you've got to know what exceptions exist. And so loans by a disqualified person to the private foundation are permitted as long as they are interest-free and used to carry out the foundation's purposes. A disqualified person can also lease property to the private foundation if it is without charge. Now, the private foundation can't make a loan or can't do a lease to a disqualified person. But the reverse works.
It doesn't matter, like you said earlier, if those are at fair market rates or even higher than fair market value rates that would benefit the charity or the private foundation here. It still just doesn't work.
Yeah, and we have some foundations that use some property that's owned by a disqualified person to conduct some activities, and we do lease the property to them without charge, and it's used to further the purposes.
And this is different than the public charity rules where you could have a scenario where a director or officer
Absolutely.
may not be recommended to do it, but they have a scenario where there's a loan or a lease that involves.
And then you have to comply with the rules to make sure it's arm's length. But here, it doesn't matter if it's arm's length or even favorable. You just can't do them. Good services or facilities, the private foundation can give those to the disqualified person if it's done on the same basis as they make those services or goods available to the general public. The private foundation, the disqualified person, again, can provide good services or facilities to the private foundation as long as it's without charge and used exclusively for the foundation's purposes. And then here's the big exception that is used quite frequently in the private foundation context. You can pay reasonable compensation for personal services or reimburse expenses as long as it's necessary to carry out exempt purposes. We're going to talk a little bit more about that in a minute, but the keys here are reasonable compensation, and the statutory phrase is not excessive, has to be personal services, and that is considered managerial or professional services, investment management, things like that work, but accounting, legal, just actual management of the organization. I'll give you an example of one where I had a client who owned an historic property and one of the directors was paid to cut the grass. That is not a personal service and resulted in an act of self-dealing. And so we actually had to report that one.
What about if a director's traveling to a board meeting, you want to reimburse them for their mileage or something? Is that fall within this exception?
Yes, because as long as it's related to foundation work, that would be a reimbursement of expenses. And again, your services as a you can pay directors of the foundation, although often they're not. But you can pay them because your services as a director are personal services. Interestingly, there's no guidance on that, but we've looked at it, and the IRS implicitly has said serving as a director is a personal service.
So even if someone's a director and doesn't get paid to be a director, if they're, for example, also an employee of the foundation and doing, grant making or overseeing that, that doesn't mean they can't be paid, but we got to be careful about what's reasonable, and sometimes that would involve having outside,
Yeah, and there's some very good resources. The Council on Foundations does a series of surveys on compensation of board members, staff members of foundations, and you can buy that material fairly inexpensively on their website, and it does it by geographic region, by size, and all kinds of things. So that's where a lot of organizations go to figure it out. And then there's certain corporate transactions. The that are not acts of self-dealing, and the primary one that we use there is a corporate redemption, where you have a corporation that is a disqualified person, and they want to redeem stock. You can do that as long as you offer to redeem all of the shareholders having the same class of stock, and it is for fair market value. Go to the next slide.
We have one question we're going to answer real quick
okay.
while we're here, since it's a straightforward question. Michele, if a disqualified person wants to transfer property they own to the foundation, do they have to transfer the property free of charge?
Well, if they can make a gift, and in fact, that's what many families do. I mean, they make gifts of property to their foundation. They cannot sell property to their own foundation.
So, and different with a public charity where you might have a bargain sale situation, that's not going to be something that a disqualified person could do with a private foundation.
Correct.
Because that would be a sale.
And there is a provision in the regulations around bargain sales that if it is the very first transaction that causes the person to become the disqualified person, it's okay. But once they are a disqualified person and a substantial contributor, you can't do a bargain sale with the private foundation.
Great. All right, so now we're going to move on to some common self-dealing issues that we deal with.
Yeah, just kind of looked at try to think about some of the areas where we get questions regularly. Co-investments is one of the common areas where we have self-dealing issues. A couple of different ways this can arise. You might have a piece of property and you give a partial interest in the property to the foundation. That can actually create self-dealing issues. The IRS does not like co-ownership of property. However, if you move it into an LLC and have co-ownership of the LLC, the IRS has been more lenient and has allowed those types of co-investment arrangements. But if you have parties, disqualified persons and the private foundation owning an LLC, whether it's an investment fund, a real estate LLC, you have to be very, very careful that transactions with the family or that involve the family, whether it's some type of redemption, that the private foundation is not being mistreated and that the family is not being beneficially treated. You have to be very, very careful in transactions inside or involving the LLC.
We've seen this pop up when you have, say, for example, a family office that's managing the investments of the family, and the family's transferred property or assets
and a lot
to
of
the
times
foundation.
they'll do a fund, some type of co-investment fund.
And so now you've got foundation funds being invested, not just in stocks and stuff that's managed, outside, but maybe some alternative investments where you've got wanting to pool the capital to get a better.
And one of the common areas that we see issues around is, particularly like in the family office context, if that family office, the investment managers are trying to get the family into a particular investment and there's a minimum required to invest, they will often say, well, we'll add the foundation on to meet the minimum. That doesn't work. The family can't ride on the foundation's coattails. The foundation can ride on the family's coattails. So, and same goes with fees. You will also often see fee reductions depending on how much is managed. You can't use the foundation's assets to get the family a lower rate, but you can use the family's assets to get the foundation a lower rate. So you have to be very, very careful there. And that comes up quite frequently with corporate trustees, outside investment managers, and just making these investments where their minimum required amounts to invest. We talked about the compensation thing, and so wanted to clarify that you can compensate family members who are disqualified persons for personal services if they work for the foundation. You can also compensate disqualified persons who are providing investment management. This comes up quite frequently in the family office context, as well as just a lot of the families that have wealth. Many of them are in the investment field, and they have foundations and also want to invest the money of the foundation, and they can. And again, reasonableness is required. You can compensate someone who's a lawyer or an accountant or providing other professional services. The key on the personal services and having a family member actually working for the foundation is the family member has to actually work. You can't just say, well, reasonable compensation is $100,000 a year and they just get paid $100,000 and never show up. They actually have to work for the foundation. So it's a two-way street there.
So on that front, it's important to have some documentation or some sort of way to prove, if you're ever questioned by the IRS, that the family members are doing something, whether it's attending meetings or going on site visits to grantees or whatever it is they're going to do. Keeping track of that is going to be important.
And that comes up frequently with family offices who are working for both, where the foundation might be reimbursing for the cost of staff time at the family office, and that's fine. The family office is likely a disqualified person, but you can reimburse, but you need to keep records so that you can show that this person actually worked X hours for the foundation.
But the family, doesn't have to be compensated. We're not saying you have to.
Many people do not have pay any of the family members. It's all volunteer. They don't pay directors, but they can. And then one of the areas that we do see come up quite frequently is where the foundation is paying a disqualified person's legal obligations. Typically, it's in the context of a binding pledge. The family member goes out and makes a legally binding pledge to a charity and then goes and has its foundation pay that pledge. That is an act of self-dealing. The way around that is to either not make legally binding pledges and just make non-binding pledges, or have the foundation make the pledge, and then you have flexibility on where you're actually going to satisfy them, from what source you're going to satisfy the pledge.
Michele, we get this question: is it a legally binding pledge? And we get agreements where the charity that received the pledge puts in there, this is a legally binding,
but it's not
pledge. And why do they do
that? There has to be consideration to have a legally binding pledge, and I've actually had to go to a charity so that the client could pay it from the foundation like they wanted to do. Go to the charity and say, you said it's legally binding, but I need you to give me a letter saying it's not. And they do, most of the time, because they want to get their money. They don't really care where it comes from.
But the charities put that in their gift or grants agreements because they want some attempt to hook on to say that the money is owed, but whether it's actually legally binding is not going to be just because the words on the paper say it is.
Yeah. One of the other areas, we talked a little bit about loans. I'm not going to spend any more time on that. And the grant making, let's say it's a corporate foundation, or it could be even a family foundation, where there are grants being made that provide some type of benefit back to the for-profit. And naming rights and things like that don't matter. Those are typically considered incidental and tenuous benefits, and there's an exception for those. So you can, for example, make a grant and have something named after a disqualified person. But sometimes these grants are being done so that, let's say it's to rehabilitate an area and the disqualified person owns land in that area and it's going to make their property more valuable. It might work, but you have to be careful where you're seeing that. Or sometimes a for-profit corporation might be trying to achieve something in a particular area, and they don't want, or they start making grants to generate some goodwill, but it's really all being done so that the for-profit corporation can achieve what they're trying to achieve when there's more of a business reason for these grants. Those are the types of things that require further analysis before you do it. And I think, and then the incidental and tenuous benefits they're ignored, and that's an exception under the rule that any transfer to or use by or for the benefit of the disqualified person. And that can be really helpful in a lot of situations.
On the lease one, we've had questions before about sharing of space and reimbursement of expenses, for example, utilities and things, and that's one that we've dealt with. And how do we kind of work around those?
You really can't do a sublease. Like if you have a family office and they want to sublease some of the space to the family foundation, you can't do that. You either need to have the family office pay for all of it. That's one option. Or you have separate leases with the landlord. The best thing in those sharing of space is to have separate vendor agreements, whether it's a landlord, the telephones, the computers, all of that. It's best to separate that out.
Right, and so we've dealt with those, and those are things where you can contract around some things, but you have to be aware that, while we say there's ability to have, reimbursement of expenses, there's questions that we have to work around. So All right.
And again, this is where we spend most of our time on private foundation issues, is in the self-dealing rules. It's not the only place, but this is where they arise. And the key today is to make sure have a good overview of when you might have an issue and need to dig further on whether or not. And again, we try to educate our clients to come to us first before they do the transaction, because once you've done it, there's little leeway to fix it and avoid tax.
All right. So we have a question about dealing with binding pledges, and we said that when the foundation makes the pledge, it's okay because that's not going to have a self-dealing issue.
And the family could decide they're going to pay it on their behalf, on the foundation's behalf, because that's not self-dealing. It's when you're satisfying the disqualified person's obligation that it's self-dealing.
And the other question here deals with, kind of an indirect kind of concept of self-dealing. So, for example, if there's a grant to a nonprofit where a disqualified person is actually working, is that some sort of worry that you're going to try to get around?
Yes, actually, that is a concern. We have had that come up. Usually can be done. There's some private letter rulings on that issue where if the grant is being made to an organization where a disqualified person works, you want to ensure that the grant is not being made to cover that person's salary. And so the private letter rulings that are out there said it's not an act of self-dealing if that's the case, and they've required, or at least in the facts of those rulings, there has been an affidavit from the grantee organization saying we have sufficient funds to pay the salary. We're not paying it through this grant.
Right. So it would be important not to have any earmarking going on there, and then also maybe even needing the extra affidavit.
Yeah, you certainly wouldn't want one that says we're going to make a payment so that you can hire a person.
Or child.
Although, you also come back and say, well, you couldn't pay for personal services, but we typically follow the way the IRS has addressed it in private letter rulings. And so but again, you have to be careful when you have disqualified persons that are involved with charitable organizations that might be grantees of the foundation.
And to close out on self-dealing, you mentioned incidental and tenuous. What are the common examples that we usually see fall under this incidental and tenuous kind of benefit? There are a couple of them. One, the naming rights and public recognition is the big one and that comes up all the time, particularly on corporate foundations, but it also arises with family foundations. And then the other one is some type of program. I'll give you an example that's in the regulations. Some type of program that's for the benefit of the general public, but could have some tangential benefit that's kind of incidental to the grant. The example in the regulations is a grant from an electric company foundation that provides for installing streetlights in an area of the city that has a lot of crime, and so it's an improvement for the benefit of the public, but it also generates more electric bills and payments to the electric company. And the IRS has said that's just incidental. The public benefit was the primary purpose of that grant. But you have to be careful, and there's not always an answer. Sometimes you can find a ruling that addresses it, but other times you're just kind of having to objectively or subjectively figure out whether you think it is something that's within the incidental and tenuous benefits exception. I guess the last one we can think about before we move on to another topic would be the situation where a foundation gets tickets to an event or something where there's common
We should have had that one on the list because that one does come all the time. Yeah, where a foundation makes a grant and it's sponsorship payment for an event that a charity's holding, and they get rights, a table at the event. And many foundations just forego the benefits and say, we don't want any tickets, we don't want a table. But then the question is, if the foundation takes the table and disqualified persons use the table, is that an act of self-dealing? And it can be. If the disqualified persons who are there have no reason on behalf of the foundation to be there. So if you have the board of the foundation attending, and they are there because they support this organization and they're interested and involved in the activities of the grantee, that would probably be fine. But if they all bring their spouses, and this is like the charity event of the year that everybody wants to go to, and they bring maybe the last other family members who have no real connection to the foundation, that is likely to be an act of self-dealing. One commentator or one author who's written a lot in this area calls it the rubber chicken rule. If it's a dinner nobody wants to go to because you're eating the rubber chicken, probably okay. If it's the event everybody wants to be at, you've got to exercise some more caution.
So we look at this and we kind of think hard about, what's the purpose of the people attending. They're making a presentation, they're doing something, getting an award. You can see scenarios where it is part of the foundation business to be there.
And sometimes it's an oversight to understand what the grantee is doing.
Right. But bringing the whole family along to get the free meal at the special event that rewards everyone, that can be one where we get into trouble. All right, so we've talked a lot about self-dealing. We're going to switch gears because we want to make sure we cover all the highlights of the various rules that apply to private foundations. So switching next to minimum distributions. Everyone has in their head that private foundations that are non-operating must distribute 5% of their average net fair market value for their non-charitable use assets, and there's this distribution requirement distributed by the end of the next year. And if you don't do that, there's a tax pretty substantial on the undistributed amount of 30%, and not corrected, another 100% tax is imposed. This tax, though, is on the foundation.
Yes.
Yeah, so this is different than self-dealing, where it was involving a tax on, or an excise tax on the disqualified person. Here we have a tax on the actual foundation for failing to do this minimum distribution that's required. Now, if you distribute more in 1 year than you have to, there is a concept of excess distributions that kind of carry forward, but that's just one that only lasts for 5 years, so be aware that they're not indefinitely carrying forward.
And all of these are calculated on the Form 990, and you calculate it for 1 year, and you have to complete the distributions by the end of the next year. So you should know every year what amount the foundation has to distribute to avoid an excise tax in the next year.
Right, and for that startup year of the foundation, there is some pro rata rules about how many months you have to count in the first year, but after that, it's basically 5% of.
And there's special rules about allowing you to hold back a certain amount of cash from the assets that you're counting, just to have some liquidity. There are rules as well about how you value certain assets and whatnot. So, we're very high level discussion of the overall rule, but there are details in the regulations.
So when you're making these distributions, you'll see we're calling them qualifying distributions. So not everything you spend money on as a foundation is going to count towards these 5% minimum distribution rule requirements. A payment for a charitable purpose. So we can easily think of the grant that we make to the charities. That's clearly going to be a qualifying distribution when they're made to public charities. We had note on here other than type 3, non-functionally integrated. We're not going to get into the weeds of that one. But that's one example. Administrative expenses, things that are due to operating the charity,
but not investment expenses.
But not investment. So administrative expenses, not investment. And you'll see on the first page of your 990 PF, there's columns that kind of segregate the charitable activity, the administrative, and the investment activity.
So if you have staff and they're doing both investment functions as well as charitable activities, which would be the grant making activities and other things, you need to be able to allocate between their salary between the two things so that you can properly determine the qualifying distributions, or qualifying distribution amount.
And then you'll see on the next bullet on here, any amount paid to acquire an asset used in carrying out your exempt purposes type of there. But that situation, you're going to purchase something that's going to be part of your charitable activity. That's not purchasing an investment activity that generates money that you then use.
Unless it's a program related investment. And that's a whole, that again, we could spend an hour on today, and we don't have time today, but program-related investments are actually qualifying distributions for the foundation, and that asset would fall out of the calculation entirely as a charitable use asset.
But for the rule of thumb for just thinking through, your administrative expenses are easy to count, and your grants that you actually make to public charities, those are easy to count. If that's over 5%, some of this other gray stuff you don't have to focus as much on. But if you're worried that you're not going to make the 5%, there's some more research and analysis you need to do for these other types of distributions to see if they fall within. The other big category here at the bottom is grants to controlled organizations or other private foundations will not generally qualify as a qualifying distribution unless that recipient, that grantee, meets this redistribution rules. And the redistribution rules, are a little bit complicated because now they've got to send the money out to another charity, usually needs to be to a public charity, to meet those redistribution rules out of what we call the corpus of the distribution. And it's got to be done in a certain time period, and you got to get information back from them,
right,
so that you know it was done or completed.
And then we're going to see that the taxable expenditure rules also kick into these types of grants, which we'll talk about shortly.
Right, and the problem here comes in, and we'll move on to our examples and just kind of finish this one while we're there, is, what happens if they don't do it? What if they don't distribute it out within the period of time required?
You can't count it as a qualifying distribution, and you may have I think it comes back in, and so you have to redistribute it that year yourself.
Right.
So it adds to, if you're distributing 5%, whatever amount you had distributed to that private foundation that didn't redistribute, you're going to have to go and distribute that amount too. So right. It can cause some issues
and so
complexities.
That worries you sometimes if you're running close to your 5%, or if you're relying heavily, if it's a large distribution to a non-public charity or a private non-operating foundation, where, are they going to do what they need to do? When we talk about taxable expenditures, we'll talk about having grant agreements and other things that require this. But I had an example last week where someone, had a grant agreement. It required them to do what they were supposed to do and distribute out within the time frame. They just didn't do it. And so then the question is, well, what happened? The good news for this client that we were reviewing their returns last week for, they had well over 5%. So it didn't actually, result in any harm to our client, who now couldn't count that as a qualifying distribution. But if that would have been a very core part of their grant making, it could result in some problems. Looking at the other common issues we get asked about for the minimum distribution rules is, think about the scenario where a founding member puts in land or some sort of asset that's not liquid into the
private equity funds and things that you can't get out of.
Alternative investments.
Funds, that have lockup periods.
Or you put in something that has some value, but it's not generating cash. So it's not generating the liquidity that you need to make your 5% distribution. And so, Michele, what happens if a client's envisioning putting in this illiquid asset? What do we do?
It's okay as long as they realize they're going to have to put some other money in or assets in that allow them to meet this liquidity need. And we also, we do have private foundations that use alternative investments and illiquid investments, but we tend to see the private foundations keeping those types of investments on the lower end, maybe 10, 15%. The bulk of the assets are more liquid. But if you have a client that's putting illiquid assets in and that's all they want to fund it with, they're going to run into issues if it's not generating any cash flow.
So in that scenario, we'll advise them that, you can go forward, but realizing that you might as well go ahead and put cash in or some other asset.
Or you may have to be putting money in over time, liquid assets in over time to fund it.
And that works, and there's nothing wrong with that approach, as long as they have the cash flow on their personal side or corporate side to make the distributions or contributions in to allow for the distributions out. If it's an asset that doesn't have a lockup period, but it's something that you think is going to increase in value, it may be one you want the foundation to hold. And so now they're going to, instead of gifting out interest in that asset, they're going to have other ways to satisfy the minimum distribution rule. So just some planning up front before the assets go in is important. And this ties into what you talked about with the self-dealing. You can't get a lot of these assets out if it's, buying it out from the family disqualified persons. They can't buy them back out. So that's really a decision you really got to walk through before it's put into the foundation.
And then the alternative investments also create some valuation issues.
Yeah, so the second bullet on here is investments that are hard to value. Because remember, we said the way this process works is it's 5% of the value of the assets that are not part of your charitable activities. And so that means you got to value them. And for publicly traded stocks, it's a lot of times it's easy to do. It's easy to calculate because you can look up on the exchange, whatever, trading it's at right now. It's the other assets.
And even real estate's not difficult because you have to get it appraised, but I think you can do it every 5 years under the regulations. It's the alternative investments that are difficult to value, where you may not be able to get beyond whatever statement the manager's providing you, which hopefully is right, but probably not entirely accurate, you may not, and they might not give you access to actually have an appraiser come in and value it. Probably won't give you that access. And so the worry is that you undervalue it and then end up under distributing.
And when you're looking at all these, especially when you're trying to value, we're looking at the fair market value, not looking at cost basis or anything like that. So that's the issue with putting in these assets that change. The example we had the other day was someone looking at putting in maybe like cryptocurrency or something, and just the spikes and valleys and of things, the assets like that. You really could run into trouble with your calculation of your minimum distribution, because it is the fair market value and the changes that go back and forth. So being aware of that, you've got to value it, and there are very particular rules about how often you have to revalue it. And so there's some exceptions for not having to do it every year, but there are rules that look through when you have to do this. So these are things that are important to look at when you're looking to make sure you satisfy the minimum distribution. Now, if you're distributing a lot more than 5%, maybe these aren't as front of mind worry, but if it's a foundation that's truly just distributing the 5% every year, you want to do that. So for our bank clients that are out there, they're going to look very closely at this, because they want to make sure they're meeting the distribution if the trust instrument or whatever they're working with.
Yeah, sometimes you're limited.
You're limited to distributing only the minimum that you're allowed to distribute, that 5%. So getting these valuation rights right is important. So as we move on, we're going to switch gears again, and we're going to focus next on Michele talking to us about excess business holdings.
We're going to do a very high level on this. These are probably the most complex rules in the private foundation area, at least to me they are. The excess business holdings rules were designed to prevent people running foundations from running family businesses. And so what they say is that a private foundation cannot hold but so much of a business enterprise. Now, business enterprises are true operating businesses for the most part, but it wouldn't include a functionally related business, a program-related investment, or a business where at least 95% of the gross income is derived from passive sources. And that's passive within the meaning of the unrelated business taxable income rules, which would basically exclude dividends, interest, capital gains, rents, royalties, things like that, and treat those as passive. But if you have, like, let's just say a business making widgets that you put into the private foundation, then you've got to start dealing with these rules. The permitted holdings, what the foundation can hold, is no more than 20% of the voting stock or the profits interest, if it's not a corporate entity, reduced by the ownership of all disqualified persons. So if the family owns 100% and you put 20% in the foundation, you have an excess business holding, because the foundation is deemed to own collectively 20%. You have to reduce the foundation's holding by what the family owns, or permitted holding. So, this would be a problem. Now, there are a bunch of special rules. There's a de minimis rule where if you don't own more than 2% of the voting stock and not more than 2% of the value of all outstanding shares, that's okay. There's some special rules around non-voting stock, but again, we're getting into. There's a lot of complexity that we're going to try to not get into today. If you have an excess business holding, there's a 10% excise tax imposed on the private foundation, and if it's not corrected, there's an additional 200% tax. And the tax is on the amount of the excess business holding, which could be a lot of money if it's a valuable business that's in there. Now, one of the big rule and the takeaway for today is to remember that if a donor transfers business holdings by gift or bequest to the private foundation, they can be held for 5 years before these rules kick in. There's a 5-year grace period.
And that 5 years starts upon
gift, receipt.
Actually receipt. So
not when they die with a bequest, it's when it actually is transferred. So you can actually, if you have a business interest that's held in an estate or a revocable trust, and it's going to go to the private foundation, to the extent you can keep it over in the estate or trust, you're buying a little more time over the 5 years. That 5 years can be extended for up to an additional 5 years if you can prove to the IRS, and you have to go and ask for an extension, and you're not automatically going to get it, and it's not automatically going to be 5 years. It's whatever amount of time is needed to actually dispose of it, and the IRS will not give you an extension unless you can show that you have been trying to dispose of it, and there are good reasons why you can't.
And you can see the tension here, because a lot of times the founder of the company wants the foundation and the family to keep control, and so these rules kind of butt up against that personal goal of the founder. Now, we've seen in the last couple years a strategy that people have used. There's two different paths people have gone down. There's some really technical restrictions to allow you to do it, called the Newman zone, for people that are looking at doing this, but that limits the amount of control over the business that the foundation
the family has to be basically, and this came about because of Newman's own. It was a specially designed rule, designed specifically to fit the situation of Newman's own, which is owned by a family foundation. But you have to segregate the family really can't be running the business anymore, and they also can't really control the foundation.
So the other strategy we've seen more recently is staying out of this private foundation world and the use of 501c4 social welfare organizations. And we saw this with the founder of Patagonia, who put 98% of the value of Patagonia stock in a C4. Now, it didn't say in any of the guide articles that talked about this that they were trying to avoid excess business holdings, but it is clear that by putting it in a C4, these rules don't apply.
Correct.
And the family can continue to own the voting stock, and the foundation, the C4 organization, is going to own 90% of the stock that generates the revenue to do the things that they want it to do.
Yeah, and as of now, this works. I'm waiting for the IRS to figure it out in Congress and see what more to be seen on that one. The other key, the key when you need to be worrying about excess business holdings is when you have disqualified persons and private foundations owning business enterprises together. If you're doing some type of investment fund and it can't meet the 95% rule for passive income, then you're going to have excess business holdings issues to address. And if you have acquired like an investment fund as opposed to a gift to the foundation, you may land in the suit immediately as opposed to having this 5-year window to dispose of it. And then the key here is also understanding how to plan for the sale of the business after the 5-year, because you need to have it sold before the 5-year period passes. And what we see typically is, sales to third parties. Again, the family typically can't buy it back. You might use the corporate redemption exception for self-dealing if that works, and allow the private foundation's interest to be bought by the company. But for that exception to apply, you have to offer to redeem everybody. And sometimes the company can't afford to buy anybody other than the foundation. And so they have to be in a position where they could actually buy everybody who might exercise the option. You can also do this in a series. Other things we'll see, sometimes we've converted a private foundation to a type 1 supporting organization. So it's no longer subject to the excess business holdings rules. You can also distribute the business to a public charity and get it out of the foundation or get it down to a permitted holding.
Now, one issue here, looking at the question of attribution and trying to figure out, what is this, how do we calculate this permitted holdings of 20% that we talked about on the last slide? And it's reduced by the holdings of disqualified persons. And so if a relative of one of the disqualified persons owns an interest in the business, it potentially could reduce the permitted holdings if that relative is also a disqualified person.
Yeah, and then we have a question about how you deal with these rules if you've got, how the attribution rules kick in. The attribution rules do apply. They are incredibly complex. You have to look at things like who has a power of appointment. It's not tied to who's a trustee, but it is tied to who owns the beneficial interest in, for example, a trust. There can be significant complexity. And when you go to figure out who actually owns the business and who gets pulled in for determining the foundation's ownership percentage and permitted holdings.
All right, real quick, why don't you talk about Jeopardy investments before we move?
Jeopardy investment rule is one that rarely comes up, and the IRS really hasn't enforced it. It is in there to ensure that foundations aren't making speculative investments and are actually working towards carrying out charitable purposes. So a private foundation is not allowed to invest assets in a manner that jeopardizes its ability to accomplish its exempt purposes. Basically, you want to know that the directors, trustees, officers are exercising ordinary business care and prudence in making investment decisions. And then, you could do program-related investments. We can now, the IRS has came out with a notice probably close to 10 years ago now, that you can do mission-related and impact investments, and those would not be jeopardizing investments. The only time I've really seen jeopardy investments talked about where there were a lot of private foundations who had invested with Bernie Madoff, and a lot of other foundations did not because they said, based on their due diligence, they couldn't figure it out. And so the question arose as to whether or not those that didn't exercise ordinary business care and prudence. It was raised initially. I didn't see anything ever come out of any of it. So again, I don't think there was any, well, it's hard to say because we don't know everybody and what happens to them, but I don't think there was a lot done around the Madoff case. But again, this one doesn't come up very often. But right. It's in the rule, and it's in there, and you need to be aware of it.
So kind of wrapping up on these kind of special rules applicable to private foundations, the last topic is taxable expenditures. So these are concerns that could subject you to excise tax if the private foundation engages in one of these. And the examples we have here are grants or expenditures to carry out propaganda or influence public election. We talked about that at the beginning, that they can't engage in these activities. If they do, that's a taxable expenditure and excise tax applies. That one's not one that comes up a ton. The next one is the one that comes up the most for us, is questions about grants to individuals. We talked about at the beginning that common for non-operating private foundations to make grants to charities, but there are situations where non-operating private foundations will make grants to individuals if it's for travel or study. So think of scholarships and ideas like that. That would be a taxable expenditure unless it's awarded on an objective basis, non-discriminatory, and is pursuant to procedures approved by the IRS in advance. And that's the key point on this one, is it has to be advanced approval. We've run into this scenario where the foundation's made a scholarship without the advance approval, and the question is, well, what do we do? And we have to go in and get approval from the IRS and seek relief.
And the problem is it's not a situation you can correct, so you're relying on some regulations that say if you can't correct it, then you don't have to pay the secondary tax as long as it was used for a scholarship, and you ultimately get your processes approved.
Right.
So the key here is don't do scholarships until you've got advance approval. And you do have a little bit of leeway, because if you file for it and the IRS doesn't respond within 45 days, you can commence and continue unless and until the IRS tells you your processes aren't approved. And it's not a difficult process to get the approval.
No, I think that the difficulty is making sure you do the approval process in advance. So filling out the 1023 when you're doing the initial application for the private foundation, if you know they're going to make scholarships, go ahead and put it on there. If it's something that comes up after you've gotten your tax determination as an exempt organization, there's another Form 8940 that you would use to apply for this. Doing that before you engage in these procedures. If it's a corporate foundation, we run into questions where there's a little more stringent rules about doing a scholarship that relates to children of employees.
That's a whole nother.
Right.
Don't ever do that without getting legal advice.
But just being aware that any type of scholarship or a grant individual, there's special rules that could kick in and apply there. If you're doing a grant to an organization other than a public charity, so not the public charity ones, but private foundations, there's extra rules called expenditure responsibility. And that one we're not going to go over in much detail today, but there is special things you must do to meet these rules to avoid the penalties or excise tax for this. And then expenditures for any purpose other than exempt purpose. So if you inadvertently make a distribution that's not for an exempt purpose, that would be...
You pay for the founder's child's wedding.
Right.
Inadvertently.
Yeah, inadvertently. And you catch it. You got to make sure you deal with that. The penalty on this is 20% of the amount of the taxable expenditure. It's on the foundation. So unlike the self-dealing, this is also on the foundation. There's a 5% tax with a cap of $10,000 for the directors, trustees. And that, similar to the other rules, there's an additional tax if these things are not corrected timely. So that's one you want to be worried about. So to wrap up with the taxable expenditures, these are the areas where we're seeing common issues. So Michele, inadvertent grants to non-public charities.
Yeah, you've got to check the status of the organization in advance. You know, some things are private foundations that you don't think they are. They don't always look like a private foundation. They're not tied to a family, but for some reason they've lost public charity status. You know, if but you can do grants. You can even do grants to C4s and C6s and even for profits if they're for a charitable purpose and you do expenditure responsibility. And of course, we talked about the scholarships. And one thing to point out is many taxable expenditures may also give rise to an act of self-dealing, particularly when you're paying improper expenses.
So to wrap up on the expenditure responsibility, this is a list of what needs to be done to meet the expenditure responsibility rules. Certain inquiry up front to make sure it's a valid charity. That includes, verifying its status, a written grant agreement, which is important to document what they're allowed to do with the money and what happens if they're not using it for the right purpose, and then reporting it back to the IRS on your 990 PF is going to be part of this process. The last slide, and we'll wrap up, deals with public disclosure. Remember that private foundation tax returns, 990 PFs, just like the 990s, need to be open to the public. So if someone requests the last 3 years of your filings, you got to make them available. And in addition to that, your 1023
and the
your
big
IRS
thing with the 990 is the 990 PF, there is no redaction of the donor's name. So clients need to understand that people are going to know how much they put in, and they're going to know who's on the board. They're going to know who they're making grants to. So
and
that
if
is all
paying
public.
Compensation to anyone
that's also going to be public.
Going to be disclosed. So I think that's really the highlights of what we wanted to cover today. We really appreciate you joining us. We did have one question, Michele.
Well, one on whether we're using trusts or corporations. I tend to use corporate entities. I think in other parts of the country we see trusts. I use trusts when if there's any chance that we're going to have unrelated business taxable income. The rules right now are more favorable for trusts in the unrelated business taxable income area. But I also use them when I have a donor who really wants to be able to control the purposes into the future. And it's harder to modify the purposes in a trust entity than it is in a corporate entity. So we tend to use the trust in that circumstance. But other people in the country use trusts all the time. And so it's a mix. But I just like the flexibility of the corporate governance for a foundation that's going to last into the future.
Great. Well, we're out of time. And
we also have questions about circulating the slides, and I think we can certainly circulate the slides.
Right.
And we have an outline as well.
Yes, we'll make sure those are made available to you all. And we appreciate your time. If we didn't answer any of your questions and we're run out of time, we'll try to address those offline. But thank you for joining us today and participating in this webinar. Have a good rest of your day.